So here's the question nobody seems to be asking. If annuities are specifically designed to make sure you never run out of money, why are so many financially savvy retirees still afraid of them? Well, today I want to unpack what economists call the annuity paradox. In other words, why do annuities have one of the worst reputations in finance, even though they were literally designed to solve retirement's biggest risks? By the end of this video, you'll have a clear picture of whether shifting part of your retirement into a protected income position actually improves your overall plan, and you'll know exactly what questions to ask before you do. But first, I want to tell you a quick story. A few months ago, I spoke with a couple in their early 60s who had done everything right when it came to planning for their retirement. They saved diligently, built a $750,000 portfolio, worked with advisors for decades. But they had one fear they couldn't shake. What if the market crashes right after we retire? And that's a fair question because retirement isn't about average returns. It's about timing. If the market drops 20 to 30% in the first 5 years of retirement while you're still withdrawing your income, that damage can become permanent. It's called the sequence of returns risk, and most retirees don't see it until it's coming too late. From a purely logical standpoint, annuities solve that problem. They can guarantee lifetime income, eliminate longevity risk, protect principal from market crashes, and create predictable retirement paychecks. So why don't more retirees use them? Well, that's exactly what we're going to unpack. And here are the top reasons why Americans hate annuities. Number one is the fear of losing control of their assets. Most retirees think buying an annuity means handing over their money, writing a check, and never seeing that principal again. And that fear is very powerful. And honestly, for certain older annuity products, it wasn't entirely wrong. But modern fixed index annuities work very differently. With a properly structured FIA, your principal is protected from market loss. If the market drops 30%, your account doesn't lose a dime due to market performance. And during the deferral period, you still have access to your money, typically up to 10% penalty free each year. So you're not giving up control, you're just repositioning that risk. That's a significant difference. And if you're between 59 and 79 with at least 250,000 saved, that distinction matters more than most people realize. Number two, the low return myth. Another reason retirees hesitate is the assumption that annuities equal low returns, but that's based on old products. Modern fixed index annuities are linked to indexes like the S&P 500. You don't capture all the upside, but you don't take any of the downside either. Many top S&P caps right now sit between 9 and 11% range, depending on the term and the carrier. And historically, that can translate into 5 to 7% average over a 10-year period with zero market risk. Now let that sink in. If you earn 7% annually for 10 years, your money could nearly double without ever being exposed to a market crash. Compare that to CDs hovering around 4%, fully taxable each year, or bonds that still carry interest rate risk, or traditional 60-40 portfolio that can lose 20% in a bad year. This isn't about chasing returns. It's about balancing protection and growth, and that's the big difference. Number three is the longevity blind spot. Here's a reality most retirees underestimate. If you're 65 and you're in good health, there's a meaningful probability that at least one spouse lives well into their 90s. That's potentially 30 years of income needed. 30 years! The 4% withdrawal was never a guarantee. It was a probability based on historical modeling. And if markets underperform or inflation stays elevated, that plan can break. This is where fixed index annuities with income riders become genuinely powerful. They can create guaranteed lifetime income streams similar to a pension that continues no matter how long you live, no matter what the market does. You're essentially building your own private pension. For many retirees, that covers the essentials, housing, utilities, food, so the rest of the portfolio can stay invested more strategically. This isn't about putting everything into annuity. It's about building a foundation. Number four is the inflation concern. A question I often hear is, well, what about inflation? And it's a fair concern. Traditional fixed annuities can struggle here because the rate is locked, but fixed indexed annuities participate in the market upside. So in strong years, you capture growth, which can increase your income based on if you're using an income rider. That means your future income can grow during the accumulation phase. Now, it's not a perfect solution. Nothing is. But compared to locking into a fixed 3 to 4% rate for a decade, it offers a flexibility that traditional products simply don't. Number 5 is the hidden tax trap. A lot of retirees assume their safe money is actually tax efficient, but in many cases, it isn't. CD interest is taxed every single year. Bond interest is taxed every single year. Even brokerage accounts that generate taxable dividends and capital gains annually, those are taxed. That means your money is compounding, but the IRS is taking a slice of that growth every year along the way. Over a 10 to 15 year period, that tax drag can quietly reduce the total growth of a conservative investments far more than retirees realize. Fixed indexed annuities work differently. They grow tax deferred, which means your gains compound without annual taxation until you withdraw the money. And for retirees who are already in high tax brackets or who expect taxes to rise in the future, that deferral can mean a huge difference over time. That's one reason many retirees are repositioning part of their conservative allocation into fixed index annuities rather than CDs or bonds. Not to replace their entire portfolio, but to create a more tax-efficient conservative bucket. Number 6 is not knowing what happens to your money when you die. Some retirees worry that if they die early, the insurance company keeps their money. With most modern fixed index annuities, that's simply not how it works. Your beneficiaries receive the remaining account value. This is an old school annuity structure most people picture, but product design matters enormously here. That's why working with an independent advisor, not someone tied to a single carrier, makes a real difference. We compare options across companies to find actually what fits your goals, not what pays the highest commissions. So here's the truth. Annuities aren't inherently good, but they aren't inherently bad either. They're simply tools. And then when they're used correctly, they solve specific problems: market volatility, longevity risk, income gaps, sequence of returns risk, and emotional stress that comes with not knowing if your money will last. If they're used incorrectly, they can absolutely be the wrong fit. So the real question isn't, are annuities good? The real question is, would shifting part of your retirement into a protected income generating position improve your overall plan? For many retirees between 59 and 79 with 250,000 or more saved, the answer is yes. And a portion of their assets and the peace of mind alone is worth the conversation. Because retirement isn't about beating the market, it's about sleeping at night. It's about knowing your income doesn't disappear in a crash. It's about confidence. If you want to explore what protected income strategy would look like for you, click the link in the description below and schedule a free retirement strategy consultation. We'll show you how much income you could generate for life, what current cap rates are available, how your portfolio risk could be reduced, and whether this strategy actually would make sense for your situation. There's no guesswork, there's no hype, it's just math. If you're serious about making sure you never run out of money in retirement without sacrificing growth potential, this might be one of the most important conversations that you have this year. Thanks for watching, and I'll see you in the next video.